Right, good morning then, folks, on Friday the 23rd of June. We'll get stuck in the markets. We'll see what is going on across the world of financial markets. Start with the news. We'll flick over some charts and we'll jump across to a calendar now once we get around to it. But with Japanese inflation now overnight, still remains hot, slightly lower than estimates, which is, I suppose, some sort of a positive, but still higher than the Bank of Japan's target, and still continues to be a problem, albeit not as much of a problem as the other global economy, or countries in the global economy. You can see obviously the UK inflation a lot more sticky, as we had that out earlier on the week. But Japan have struggled for inflation for a long time, so it's not the worst thing in the world for Japan to have a slight bit above target inflation. So I don't know if I'll worry too much about that if I was the Bank of Japan. Certainly not as much as the Bank of England need to worry about their own situation. Apart from that, with Jerome Powell out saying the rate hikes will come at a careful pace from here, which is understandable. 25 basis points at the next meeting, probably 25 basis points then after that then bring us to a terminal rate on the Fed funds rate. But that's what he's communicated to markets over last week and over this week. And last week, markets said, "I don't care what you have to say. I'm not really believing you." Expectations are, the 25 basis points is slightly growing, or chances of that are slightly growing. At their next meeting, they'll come from 72 to 74% over the course of this week, and markets are starting to wake up to the fact that he was not lying to them. They are going to continue hiking interest rates. You'd imagine they probably will do 50 basis points by year end, and then we'll have to see how that plays out. Markets had earlier anticipated that we may potentially get a rate cut by the end of this year, but I think, in my opinion, I think we are not going to get that. I'd be surprised if they go back to cutting interest rates by the end of this year. I think we'll have to wait till 2024 to see something like that, unless we have a strong recession quickly, or head into recession quickly, which is a possibility. But I think with the Bank of England doing what they're doing, I think the UK economy much more likely to enter a recession than the US. Now, apart from that, dollar rises, central banks cast shadow over growth outlook, dent risk sentiment, which has been a theme in markets all over the course of this week, including the Federal Reserve stoke fears that their aggressive monetary tightening could push economies into a deeper downturn, which is certainly the situation in the UK. The higher people go with interest rates, or the higher central banks go with interest rates, the more likely these economies are to enter a recession. And that is sort of what we are looking at. That is the theme in markets at the moment. The markets have soured, their sentiment has soured over the course of this week. We will jump across to some markets now in a minute, or some charts now in a minute, and we will have a look at that. But you can see again, to start the day, you can see North American equity futures lower, European equity futures lower, Asia Pacific equity futures lower, equities lower across the board. To start with commodities, gold and silver are pretty flat, but you can see crude and Brent down nearly 1% each. You can see Bitcoin, Ethereum, I'll stick that in the commodity section, as they normally move in line with risk sentiment. They are all then down. You look at US bonds, bid, but yields are lower, right? Reason for that then is obviously expectations for a potential economic downturn, and then bond yields push lower off the back of that, which is the reaction we saw yesterday off the Bank of England. We saw the yield curve inversion between the twos and tens deepen to its largest amount since 2010. So markets clearly fearing a recession in the UK, which is understandable, considering that they are going to hike interest rates probably to 6%, and that will spark a recession in the UK economy. Apart from that, global bonds slightly lower, slightly higher. Not a great deal of movement across them, but US dollar strength, markets finally waking up to the fact that the Fed weren't joking last week, and the US dollar has now strengthened off the back of that, right? So you got some hawkish comments from Jerome Powell, which has helped the dollar prove negative for equities, which also then helps the dollar. So a couple of things pointing towards dollars higher. We had a bit of weakness across dollar over the last week or two, which is starting to be reversed, and we're seeing some dollar strength play out as of now. You can see the Aussie and the Kiwi lower, in line with risk sentiment, in line with equity futures lower. You can see the Japanese yen higher, in line with the US dollar, which is off the back of still stubborn Japanese inflation, albeit lower than estimates, but still stubborn Japanese inflation. Couple that with stock indexes lower, make a good recipe for a bit of a Japanese yen pullback. and the US dollar. We can see the performance of the Japanese yen over the month to date, 3-month percentage change, also the year to date percentage change, which is, it's a sea of red across the board. So the Japanese yen, obviously the most negative currency across the board over the course of this year. So I wouldn't pay too much into a slight bit of yen strength. The trend is still quite clearly lower, as you can see from here, and I'd be somewhat careful trying to buy back in to the Japanese yen. But we'll jump over to some markets, and you can see straight away you've got US dollar strength. You got Aussie cruising lower, Euro cruising lower, Kiwi, cable a little bit choppy on the way down, obviously with the Bank of England, with the inflation figure the other day, but still cruising to the downside. You've got dollar yen, the level that we were looking at yesterday, but obviously hasn't materialized. It's continued on higher before that, but dollar yen cruising to the top side. Dollar Swiss pushing higher. Dollar CAD held surprisingly resilient in the midst of US dollar strength yesterday. Kind of just chopped around while there's a bit of US dollar strength across the board. Canadian dollar actually ended slightly higher than the US dollar, so that is of note. Right, goes in line with the strong figures out of Canada during the week, goes in line with the hawkish central bank unexpectedly hiking interest rates and potentially going to hike interest rates further. You've had positive growth, you've had positive consumer spending, positive housing figures, and then higher than anticipated inflation in Canada, and they have not gone to a point where they're hiking the economy into recession. They've still got a bit that they can do before they kind of destroy the economy, like the Bank of England are getting to. I say destroy. I mean, destroy is a bit of a strong word, but you can just tip the economy into recession. That's what gets prices down. That causes the reducement in activity, which gets prices down, which is not a bad thing. I mean, you'd probably rather suck up a slight recession than and then have to cut interest rates slightly. One, that gets mortgage rates down, and two, that gets price pressures down. Okay, you'll have a bit of an increase in unemployment and stuff, but on the balance of power, I think it's not the worst idea in the world for the UK. But anyway, that's a conversation for another day. Dollar index, you can see smashing higher. That's with euro dollar smashing lower, and that's sort of where we are at. US dollar strength is the name of the game. Certainly over the back end of this week, you can see equity still remaining under pressure. You can see the S&P trending lower over the course of this week. The Dow Jones, the Nasdaq had a pop higher yesterday, but that has rolled over and is pushing back higher. So we're looking at a bit of a level, a bit of a level. If you're going to go long stock indexes and you're hoping for stock indexes higher over the course of today, you are at a bit of a level on the Nasdaq. You got support across here with resistance here, support here, resistance here. You now broke it, come back to retest it, got yourself a little piercing pattern on the 1 hour. Oops, that's not what I wanted. You got yourself a little piercing pattern on the 1 hour on the candlestick. So if you wanted to play some long stocks, I think that is your horse to back over the course of today. But I think sentiment remains sour across the board. I probably look towards something else. If we're talking about a struggle, a recession, and the economy being affected, the Russell's the best one to play. Russell, the way it's calculated with much more companies in it, is a much better gauge when it comes to reviewing the health of the overall economy. And if that is what's in the news flow at the moment, the health of the overall economy, then the Russell's the one to back lower. So we get involved in that. Something we've been talking about for a week or two on the trade floor is this head and shoulders that we saw on the Russell. If anybody managed to get short that, where you got your head and shoulders then across there, that has then pointed lower, which has gone in line with the fundamentals, in line with risk sentiment, and has provided a pretty clear technical setup in order to get short that. So that Russell, decent trade over the course of this week. Bond yields just chopping sideways. Bit of a trend line across here, but you can just see it's chopped sideways. The 2-year yield, which is a better indication of short-term interest rates, is making an attempt at these highs, and certainly is a level that I will be keeping an eye on over the course of today. I mean, if you can get up through that resistance level up through there, shows expectations for interest rates to grow further, and that is something we need to keep an eye on, certainly over the course of today's trading session and into next week. You've got 2s and 10s on the UK, which we're speaking about yield curve inversion reaching its highest point till since 2010, and that's something worth keeping an eye on as well. If you can get above these highs, up at 5.1%, and that signals further rate increases in the UK to come. We'll see how that plays out over the course of today. I can't imagine that's positive if you get above there for UK related assets, but Yeah, we saw yesterday FTSE pushing higher at one point, which was a bit insane. You know, we were looking at this into yesterday, did push higher over the back end of yesterday, which I couldn't wrap my head around, to be honest with you. But we have come back lower. And it looks primed to attempt to move at the lows. But you can see some strong moves lower on oil. And you can see here that would clearly suggest to me that markets are fearing the state of the global economy. As long as those fears persist, oil should continue lower. Apart from that, we are on to the calendar for today. You can see inflation out of Japan, slightly lower. The consensus is expected for it to rise, didn't rise. Beat consensus on this one, although slightly below last month's figure. So in terms of what we're looking at there, you know, still stubborn inflation, not quite as high as markets may have thought in terms of the total rate. But once you less fresh food prices, which you've had kind of price hikes of in recent months in Japan, once you remove the prices of fresh food, that's the core print then. Right, and you can see still remains slightly stubborn. Retail sales, consumer spending is interesting out of the UK today. Consensus -2%, -0.2%, actual plus 0.3. So retail sales in the UK, consumer spending remaining positive in the midst of these high levels of inflation. So consumer spending not dented too much. You know, whether that's just not affecting people the way you would expect, or people are just spending money they don't have, then I don't know. But I was reading a piece on the Beyonce concert. Obviously a lot of people out and about watching Beyonce may have contributed to price pressures, people going out and spending money on that concert, people flying in and then spending money, so maybe that's a contributing factor. So, you know, it's an interesting article that I read, but that was only a couple of shows, 1 or 2 or 3 shows. I'm not gonna lie, I'm not the biggest of Beyonce fans, so I didn't follow it too much, but I was reading an article the other day. We look ahead to PMIs today. You can see some manufacturing and services PMIs out of France, out of Germany, out of the Eurozone, and out of the UK. And if I'm being perfectly honest with you, I'm not sure I can see a way in which that is spun positively. I mean, if that is a massive beat on expectations, well, gives the central banks further scope to hike interest rates. If that is a miss on expectations, well, it shows deterioration of these sectors, which goes in line with growth concerns over the course of this week. So I'm not really sure how to play that later on this afternoon. I'm not sure I'll trade it at the release, but maybe post-release you can have a look and see how markets react to it. But yeah, it's difficult to read into a way in which that you can spin that as positive, especially with sentiment in markets over the course of this week. You then do come into US manufacturing services and a composite PMI later on this afternoon, which we will cover in a bit more detail on today's European session preview. But yeah, or US session preview, should I say. But yeah, that's where we're kind of looking at the moment. Sentiment remains sour across the board. Equities remain pointed lower. US dollar strength. Does that continue on today's session? And a couple of drivers here, a few PMIs that I can't imagine are too positive for markets, whatever way you try and spin it.